Hey everybody, what's going on? It is James here with Crypto Common Sense, aka 3 Weeks Trading, and I wanted to sit down today and shoot a video. It's been a while since I've shot one. Some of you may have noticed that I deleted most of the videos from the channel. It's because I pretty much threw my hands up with it. But I wanted to sit down today and shoot this video for you because I think it's important, and I really hope you get a lot out of it. So essentially, the reality is this. Most people who are failing at trading, apart from the emotional side of trading, if you are somebody that's doing good with your emotions, but you're lacking a strategy, I think the reason that most people fail is because they're being lied to. The stuff that's taught and regurgitated is such utter nonsense. Let's talk about some of these lies that are kind of pushed over and over in the trading space. Obviously, I won't be able to cover all of them in a single video, but I do want to talk about them. And some of the most obvious ones are just glaringly obvious. So let's start with RSI. Anyone who's been around trading any length of time at all, whether it's, 6 months, 6 years, 6 weeks even, they've probably heard at some point that over 70 RSI is overbought and under 30 RSI is oversold. That is by far the biggest load of shit, well, one of the biggest loads of shit I've ever heard. It's not true in any way, shape, or form. It is not true. And the reality is this: many times when RSI gets overbought, it's actually a reason that you should be looking for longs, not shorts. And many times when it gets oversold, it's a reason to look for shorts, not longs. The catch is, like everything in trading, I think what people want is they want this simple set of rules: over 70 shorted, under 30 longed. In real life, that's not how it works. In real life, sometimes under 30 is bearish and sometimes under 30 is bullish. Sometimes over 70 is bullish and sometimes over 70 is bearish. It all depends on the context of the chart. So for example, when we look at this chart on a 5-minute chart, QQQ, it's like, well, wow, look at this, it was overbought, it was over 70, and then it almost immediately turned around, and down here it was oversold and almost immediately turned back up. So you're wrong, James. This is obviously how this works. Okay, but what happens when I look at a 1-minute chart? Now what happens when I suddenly say, well, I'm going to short it, long it because it's oversold? Well, it's oversold right here on the 151 candle. That would be this candle. Suddenly there's a huge problem here because that continued to dump over $4 a share before it finally bottomed. I don't know about you, but I don't want to be eating $4 a share loss on my trades. Okay, well, let's look at over 70. Surely at some point it was over 70, and that's overbought, they say. So what if we shorted that? Maybe that made a bunch of money and it made up for this loss. Okay, well, let's check that theory out. It broke into over 70 territory at 1224. And that would have been right here at 505.06, and then proceeded to run up, $2.22 a share. But this is what the books teach. This is what courses teach. This is what gurus teach. Over 70 is bearish and under 30 is bullish. It's bullshit is what it is. You can't trade RSI that way. It doesn't work. What you can use RSI for is to find divergences and to find trend lines. For example, I'm not going to go super deep into this, but there's a reason that this indicator, which is a custom indicator that I had written before I started coding my indicators on my own, this is like 5-6 years ago. This thing just draws lines in RSI just a little quicker than doing it by hand. And if you look, it drew this perfect trend line, and yeah, maybe, and you saw this perfect trend line confirmed, maybe then you would say, hey, maybe I want to long this, and it pops. Or maybe if you had a bunch of touches up here in a negative way going down, maybe you want to short it. That's what RSI is really great for, especially if there are divergences on top of that. Those are really powerful things. If you go out to a daily chart of the QQQ, look what you're seeing on RSI. Here you see it kind of get down around 30, and it's like, well, that was an awesome spot to buy. It just pumped right after that. Here it got very close to 30 and it pumped right after that. But see, that ignores the fact that look what happened when it got up to over 70 back here. You would have been shorting the QQQ at $390 in November of 2023, right around this area. Yikes. Okay. And that's the problem. That's why these lies exist, because people want simple. There are simple things in trading. Like some trading is simple, but it's not that simple. If it was that simple, nobody would take a trade except when RSI was under 30 or over 70. They would just program computers to literally be like, oh, it's under 30, buy it. Oh, it's over 70, sell it. That's like, why would anybody do anything different? If you know that's the way it works, you wouldn't ever trade anything else. You would take your 100% win rate. Okay, but that's not how RSI works. It's just a big lie that's told over and over. What's another lie that we can bust? This one's probably my biggest pet peeve of all. This lie that resistance, how many times have you heard this? Never long resistance, never short support. Like that's like a cliche in trading. You can like literally Google, cliches, and that's one of them that'll probably come up. And it's all nonsense, guys. Sometimes longing resistance is one of the very best trades you can take. And sometimes shorting support is one of the very best trades you can take. Let's look at today as an example. We had this range on QQQ. So there's where our highs, and we had some lows around this area. Okay. Now, full disclosure, I did trade this range and I did short this resistance level. But that's not just because it's a resistance level. I had other reasons for shorting that resistance level. And it was a trade that I had posted in Discord. It looked just like this at the time. At 126, I posted the trade up. And then it moved to the bottom of the range and hit my profit target. So sometimes I will short resistance, but I shorted that resistance because, for example, I felt like it was overextended on a 5-minute chart. I felt like it was a pullback and a downtrend on a 1-hour chart. I was seeing some supply wicks come in, which made me think that it was probably topping on the smaller time frame charts. Like this entire picture came together to tell me, hey, I think this is a place that I want to look for a short here. And that worked out beautifully. But it wasn't just because it was resistance. Sometimes I will long resistance. So let's look at the reverse side of this. What about support? Like you're supposed to short resistance and long support. That's what they teach. But in reality, probably the best trade of the day was when it broke below this support level, came down, put in essentially a little micro bear flag, and then absolutely capitulated. Moved down like $5 a share, just basically in a straight line. So, I've seen this taught over and over again where they say the more times a level of support is tested, the stronger it gets. And I've long taught my students the exact opposite. Over and over again, I've taught people that resistance and support, these levels are like a wall. And the more times I hit that wall with a sledgehammer, the more likely that wall is to fail. And so I don't understand why it's taught that these levels are supposedly stronger the more they're tested, because it makes zero sense whatsoever. What's happening, for example, when a level of support is tested over and over is demand is tested. It's there, it moves. Demand is tested, it's there, it moves. Demand is tested, it's there, it moves. But every time you take away from that demand pool, there's less and less people willing to step up. And some of these people that stepped up earlier start to get nervous about their positions and begin closing them because they think that maybe it's not as strong as it, they perceived it to be. So now they're closing their longs, which adds selling pressure. And new people are afraid to buy because it's already tested that level several times. So yes, many times it'll break. Whether it's a resistance level or a support level, it will break after it's tested several times. So this is literally the spot where I would be shorting this stock, not longing it. It's the opposite of what's taught. But if you look at this, right when that low was taken out, I did short that. I did respect the resistance level. I did the cliche short resistance. But down here, I did not respect the support level, and I did not long it down here. Oftentimes in trading, longing resistance or shorting support is one of the best possible trades you can take. For example, in this case, shorting support, the best trade of the day by far. Or if you look back in time, like over and over again, you'll see this in trading. Look at this. This is a resistance level. It came up and tested it. Okay. It failed. It moved down. It pivoted off of it. That leaves behind resistance. And in this case, it even kind of goes back a little ways. It comes up here. What does it do? It fails. It has this little baby pullback. But look what happens. It's pulling back and consolidating. It's putting in another tiny range through here, almost like a little ascending triangle. Those are not reasons for me to short that just because it's at resistance. Those are reasons for me to look at a long, because once that resistance breaks, A, you have buyers who can step up and start buying, which creates upward pressure. B, you have people who were shorting it. Now they have to close their shorts, which means they have to buy back the stock. More upward pressure. And C, you'll have even more traders sitting there waiting for the breakout, waiting for confirmation that it's a legit breakout and not just a fake out. And when they finally jump in, even more buying pressure. And you'll often get the biggest moves off of a break at resistance or support. In this case, this broke out, came back down for this little retest, and then exploded. It is not what is taught. I'm not saying nobody in the world teaches this. I'm not conceited saying I'm the only guy that teaches this. I am sure there are some really great teachers out there who do teach this, who do teach it properly. But the vast majority teach it wrong. I've bought $1,000 courses that didn't do a good job of explaining this. I'm talking about when I first started out, I bought courses from Investopedia that did a terrible job explaining this, or no job at all. I bought courses from, quote unquote, 30-year veterans who didn't teach it this way. I remember buying a TA course, and I don't want to get sued, so I'm not going to say who released it, but I remember buying a TA course like 6-7 years ago. And I remember them teaching it like all the same cliche stuff that you see on Google, right? Well, a double top is bearish, and as soon as it breaks that neckline, you should be shorting it. And as soon as a W breaks that neckline, you should be longing it. And a head and shoulders is one of the best patterns in trading. As soon as it breaks that neckline, go short. That's not wrong, okay? The problem is when they explained it, they acted like it was what always happens, okay? They acted like this is the only way to trade these patterns. And the reality is this: the best patterns in trading are failed patterns. For example, one of the best places that I have personally found to go long is on a head and shoulders that comes below its neckline, fakes everyone out, stops out the longs, and then immediately pulls back inside of that, above that support level, because this becomes a bear trap. And that liquidity fuels, a lot of times, a massive move to the upside. Or vice versa. When you get a head and shoulders that does something like this and starts a breakout, and all these traders are just longing the shit out of it because that's what everybody teaches, except institutional money is actually shorting it, eating up that liquidity, and then it does this. And same thing with double tops and double bottoms. If a double top comes down and breaks this neckline, but then immediately comes back up, oftentimes it was a fake out, and that market's going to zoom. Same thing with, inverse with a double bottom. Most patterns, they just work extremely well in the opposite way that they're taught. And that's what's crazy about it, because I remember a few people, I wish I could remember their names because I call them out and give them props. I do remember a few people saying this when I got started, how, like retail trades the patterns the way that they're taught, but institutions trade them like the reverse of that. And I was like, oh, it's such nonsense. No, it's absolutely correct. It's not 100% of the time, like anything else. It's never 100%. But a lot of times when somebody sees one of these patterns, for example, somebody sees the head and shoulders and they see it confirm and they short it, even if they do, and they're like, hey, I'm going to use proper discipline, I'm going to take my stop. They'll take their stop, but they'll never consider going long because that's a bearish pattern. But it's not. It's not a bearish pattern. It's just a pattern. It's bearish if it's confirmed and it moves down. Then in hindsight, it's bearish. But in the moment, if it's confirmed and then it's a fake out, it's actually bullish. Now, I know that's like blasphemy in the world of technical analysis. How dare you call a head and shoulders bullish? Because it is. If it's a bear trap, it is bullish. That's the thing about trading. And that's it. it boggles the mind. A friend of mine posted that I've known for several years on the internet. He posted today. He's in a different line of work. I know him from my background in internet marketing. And he talked about how, I'm going to pull his post up. So it says, if you're having success at what you're doing, don't let anyone guilt you or convince you what you're doing is wrong. Here's some examples. And he gives some examples, right? And the reason this post stood out to me and it made me want to do this video is because when I got started with internet marketing, I actually got started in 2003, but I didn't have any major success until 2011. And in 2011, I had my first six-figure year. So I made over $100,000 that year. It's the first time I'd ever done that. And I had some extraordinary milestones that year. For example, I had my first $10,000 day. And I actually had my first $100,000 month as well, but I didn't hit seven figures that year. Just a fluke that month was. I did all that by using affiliate marketing, where I had affiliates promote my software. And at the time, it was very, very cliche. And a lot of the gurus were bashing people, like not me specifically, but my business model of affiliates, saying you don't have a business if you're not running paid traffic or running ads. And I bought into that bullshit, so much so that I spent over $100,000 of my money buying guru courses to try to learn how to run a paid advertising campaign in a profitable way, because I always lost money when I tried to do paid advertising. So here I am chasing this, unicorn, or whatever you want to call it. And the reality is my business at that point was making about $30,000 a month. There was no reason for me to pivot to something else. What I was doing was working exceptionally well. But everyone kept saying I was doing it wrong. And being a young, still in my late 20s at the time, and being humble and thinking, well, I'm still pretty new at this, even though I've been doing it for 8 years, right? I was listening to these people who I later found out made less money than me. Okay. And you might wonder, how did you figure that out? I was actually at one point in time, I was one of the top 5 affiliates on a platform in that space, which meant I was outperforming all of these people who were telling me I was doing it wrong. But I literally tried to shift my entire business because of that. So I saw this post today that Derek put up and I thought, dude, this is trading. This is why people fail at trading, because it's the same shit. They will see somebody taking a trade that they don't agree with, that goes against the quote unquote common knowledge, and then they'll ridicule them for it. I got ridiculed on Twitter. A lot of you will remember this. Like, I got just ran through the mud when I suggested in 2019 that Bitcoin was not yet in a bull market and was actually going to pull back to $4,000. Like, people were just livid at me for even suggesting such a thing. In 2018, when I suggested that Bitcoin was going to fall to $3,200, people thought I was an idiot. And because so many people rallied against me, it made me doubt my own decisions. It made me doubt my own predictions. When in reality, I was spot on in both 2018 and in 2019. And then I even started doubting that. And the reality is I was right, but I just got my own head. And that happens with trading, because people think, well, everyone else says that I'm supposed to long support. I'm supposed to short resistance, and RSI over 70 is actually negative. I should short it. And there's so many of these stupid cliches that are absolute utter nonsense. They've just been repeated by so many people that they become accepted as fact when they're not fact at all. For example, after this huge move down in this consolidation period, a lot of people will tell you this is a continuation pattern. It's going to keep moving down. And yet here I am at 209 posting a trade that I'm in at that exact point in the day, a trade that worked out beautifully. Why? Because after a huge move down, when the market is overextended, and then you get a range, it's probably not a continuation pattern. It's probably a reversal pattern. And it doesn't have to be a reversal like, okay, this is the bottom, it's going to go out and take up these highs. We don't know that's going to happen. But when you look at this like on a larger time frame and you see, okay, this is where that was occurring at right here, basically back at these old lows, then you start thinking, hey, maybe this is actually like a little bear trap down here. Maybe this is actually about to pop. Like all this context matters. And that's the thing, guys. If you don't take anything else away from this video, take this away. Context is everything in trading. It is everything. Whether RSI is bullish or bearish depends on the context of the chart. Whether a range is bullish or bearish depends on the context of the chart. For example, real quick, like I said, this range back here that I shorted up at the top of the range. Okay, this looks like an uptrend. So why am I shorting? Again, another cliche. Never fight the trend. Bullshit. It depends on what's happening in the trend. Okay. This trend was overextended in my opinion. It was not just overextended. It also, to me, looked like a pullback and a downtrend. Okay. I'll show you that in a second. So this had bounced back up to the 61.8 Fibonacci level, for example, which by the way, I did not have on there. I can just eyeball it. I've seen so many thousands of charts. I have a general idea of where like the 60 to 65% level is going to sit at. But look at this hourly chart, okay? So to me, this just looked like it was about to do this. That's what it looked like. And so that's what helped set me up on that trade in that range. I kind of got the general context from looking at the larger time frames, and then on the smaller time frame, I found an entry. Another thing that I used to say, because it's what I was taught, was you need multiple reasons for a trade. You need all these reasons, all this confirmation for a trade. But you know, one thing that I've pinned on with that is I don't think you need all that much for a trade. I really don't. I think what you need is to understand whether you're in an uptrend, a downtrend, or whether you're ranging or whether you're transitioning into a range. Because if you're in a downtrend, you should be finding some excuse to get into a short. If you're uptrending, you should find some excuse to get into a long. It doesn't have to be the best trade in the world. Find a reason to get in. Find a reason to get in with a reasonable place to put a stop so that you're not clipped just from normal market noise. But if you're clipped, it's actually because the trend itself is, pausing or reversing. You want to find those reasons. If you do that shit where you're sitting back trying to find, 88 reasons for a trade, you'll just never trade. And that's one of the reasons that I could sit down at my desk at 8 o'clock in the morning Central Time, market opens at 8:30, and I could sometimes sit there all day until 3 o'clock when the close bell rang and take 1 or 2 trades. If I'm not in a trade within 5 minutes of market open anymore, or 5 minutes of sitting down, a lot of times I don't sit down to almost 9 a.m. Central Time. If I'm not in a trade within 5 minutes, it's a weird day for me. Usually I'm in a trade within 5 minutes of seeing my chart. That might sound crazy to some people, but that works for me. I don't need a gajillion reasons for a trade. I just need to look at a chart and figure out what's my trend, sideways, up, or down. If I'm sideways, I may have to wait a little bit for a setup. If I'm down, I'm going to find a reason to get short. If I'm up, I'm going to find a reason to get long. So one last thing I'll talk about, I'm going to cut this off right here because we're not going to get it. One last thing I'll talk about. Ranges get a bad reputation for being difficult to trade. Okay, I don't know if this is so much a lie like the other things as much as it's just a misunderstanding. Ranges are not difficult to trade if you trade them as a range. They're difficult to trade if you trade them like you're trying to trend trade this whole thing. But there's a little bit of a secret about ranges. They often provide the best trends within the range itself. So if you have a range, a lot of times the trends in a range are very clean. They will just go from one side to the other side. For example, up to the bottom, right back to the top, right back to near the bottom, right back near the top. That's a very clean trend if I zoomed in. It's a 1 minute chart, so it's just chop, chop, chop. But what if it was a 15-second chart? Now those are actual trends, tradable trends, okay? And I'm using like a 1 minute chart and a 15-second chart, but this same concept applies to like if you get in a range on a daily chart, there's probably some really good opportunities on an hourly chart. Or if you're ranging on a weekly chart, there's probably some really good opportunities on like a daily chart, like a daily candlestick chart. Because as you're ranging inside of that weekly range, you're probably going to be bouncing up and down that daily chart. At the end of the day, what took me years to figure out is this. all the noise and all the myths and all the, confusion, it can be pushed to the side, and trading comes down to this very simple thing. Am I trending up? Am I trending down? Am I transitioning into a range, or am I in a range? Because once you know that information, or once you feel confident that you know that information, all your decisions become very clear. If you are trending up and you believe in the trend, obviously you don't have to worry about looking for shorts. All short setups are just off the table. If you're trending down and you believe in that downtrend, well, all long setups off the table. You don't even look for them. You only look for shorts, or you only look for longs, depending on the trend. If you're at a range, then you know, hey, I shouldn't be trying to go for home run trades here. I want to trade within the bounds of this range. If I'm going long, when it gets close to the top of the range, I need to think about taking my money off the table. If I'm going short, it gets to the bottom of the range, I need to think about taking the money off the table. Some people say, yeah, what if it breaks out and leaves you behind? It most often will not. And when it does break out, more often than not, it will give you a new entry where you can just take a new trade. There's this fear of missing out because people act like they can't re-enter a position. If you close one trade for a win, and then 3 candlesticks later, a new trade comes in, great. There's no thing that says that you can't take 20 trades a day. Oh, wait, that's another lie. Overtrading. Don't overtrade. One of the worst things you can do is overtrade. Guys, if I'm not taking 10, 20 trades a day, it's because I'm not at the desk very long. Like, it is nothing for me to take 20 trades in a trade day. Nothing at all. 20 trades is nothing when you're trading 1 minute chart, or a 30-second chart, or a 15-second chart. There are dozens of spots to take trades on smaller time frames. Because again, I'm not sitting back looking for the quote unquote perfect trade. Another myth. Boy, I'm going now. This idea that you have to have this perfect trade set up and this and this and this and this. Listen, if I have an edge, meaning that I know I'm going to make money with a system, I don't give a shit about the perfect trade. Let me explain this to you. If I'm aiming for 40% win rate and I'm making $2 when right and I'm losing $1 when wrong, that means that I'm going to make money winning 40% of the time, okay? So if I see a trade that is not a great trade, it's a meh trade, and it has a 50-50 shot of winning, I'm taking the trade 100 out of 100 times because I only need to win 40% of the time to make money. So if I have a 50% chance of winning, that is an edge. That is a mathematical edge. I'm not going to skip this trade just because it doesn't have a 70% chance of winning. I don't give a shit. It's more than I need. I need at least 40%. If it's a 45% chance of winning and a 65%, yes, right? No, 55, sorry. It's 45% chance to win and 55% chance to lose. I don't care. I'm still taking it. If it's 2-1, I'm still taking it. If it's a 40% chance to win and a 60% chance to lose, I'm still taking it because that's what I need. Now, if it gets into, hey, there's a 65% chance you're going to lose, I'm not taking it because obviously then I don't have an edge anymore. But this idea of over trading is, I don't know where that comes from. I really don't. It's this weirdest thing. It's like, if I know that statistically every trade I take puts money in my pocket, meaning like I have a mathematical edge, doesn't mean I win every trade. It means on average, every trade makes money. Then I want to take as many trades as possible. This is the whole concept, by the way, behind high speed algorithms, trading and things like that. Oftentimes they're making 1 cent, 2 cent, 3 cents a trade per share, but they're doing it thousands of times a day. No one's going to go to them and be like, oh, you're over trading, sir. Ma'am, you shouldn't trade that many times. But then they'll go to a retail trader and tell them they're an idiot for taking 10 trades in a day or 5 trades in a day. What are you talking about? Like, if you have an edge, you have an edge. And the way you maximize an edge is you take as many trades as possible. Granted, if they have an edge. I'm not suggesting that somebody should go out into the market and just blindly buy and sell, buy and sell, buy and sell with no reason to do so. I'm not suggesting that somebody that's down for the day continues digging the hole deeper because they're off the mark. You have to have all these rules in place that protect you. For example, maybe you have a rule in place that says, hey, I can't, lose more than, 3R in a day. And then that's it. If you hit that number, you stop and you come back the next day. If you continue trading after that, yes, that would be an example of legitimate over trading because you're breaking your trade plan. But if I'm winning and I'm making money on every trade, why in the world would I limit the number of trades I take based on some arbitrary idea of over trading? It's ludicrous. All right. So the video is now over 35 minutes long. I'm going to have to do some editing on it. But I think that's a pretty good, brain dump. Hopefully you guys enjoyed this. Make sure you give it a thumbs up. Make sure you do subscribe to the channel if you're interested in future updates. And feel free to leave me a comment. I hope 2025 is going extremely well for you. I hope 2024 ended extremely well for you. And as always, please remember, I'm just some guy sitting in a spare bedroom with a lot of opinions. But nothing in the video is financial advice, and you should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. All right, this is James. I'll talk to you all soon.